Our next guests I met them because they came on our morning show, Pre-Market Prep, a few years ago, and they single-handedly changed how I think about IPOs, specifically whether or not to buy an IPO. Because you get all these IPOs and they're sexy and they're cool companies that we've heard of and, we can invest. They've done the research. They've done the homework, all right? So here they are, Kathy Donnelly, Eve Boboch, the Life Cycle Trade. Let's give them a hand. Maybe I should have told you that. Sorry.
Hello? Oh, I guess it's working. Hi, everybody. Well, welcome. Thank you to FinTwit and Lufkin Capital for inviting us to be here. We're excited to be here, and we're glad for the people that are staying after Brian's awesome presentation. So, welcome.
Great to meet everyone in person, the FinTwit community. Very exciting.
Okay, I don't have a clicker. It's on the... Oh, okay, thank you. All right, let's see. Okay, so again, welcome. We're titling this How to Win at Trading IPOs because we're in Vegas, right? So we're here to win. So this is hopefully going to give you an edge and what to look for and some additional maybe things that you may not be aware of. Hopefully we can share with you today. And this is how, you can find us. We are on Twitter, and we have a website with all other interviews we've done, like with Benzinga, as Spencer mentioned, if you want to learn more about us and our strategy. And of course, we have a disclaimer. I don't need to read it. You guys know the deal, so we'll go from there. All right, so we're going to talk about the IPO market. Hasn't been real great recently, as probably most of you know. You look at any IPO and you just see a huge downtrend. I mean, Brian just talked about Brothers. I mean, Unity. They're just, and here we are talking about IPO. So this is so you will be ready for when the new batch comes out. And then we'll briefly go over our research, the life cycle trade. We'll talk about the phases, the advantage, the edge that we hope to give you. And then we'll have a little bit of interactive chart reading and maybe have some prizes as well. So we'll go from there.
Exciting. Well, we're in Vegas, so we had to have a casino analogy to trading, right? Just like the casino has a number of advantages to ensure that they win over the long haul. A trader really needs to have an edge, you all know, and has to have really strong risk management, as Brian had mentioned, to be successful over time. A little bit of background regarding, I'm not sure how many people are familiar with the life cycle trade. How many people have read the book? Okay, that gives us a good feel. We conducted a research study, Kathy and I, along with Eric Kroll and Kurt Dale. We studied initial public offerings over 3 decades and super growth stocks. And the findings that we discovered, we really feel that gave us an edge for trading. And we used those findings to enhance our own trading. And that's the main reason why we decided to publish our findings in the life cycle trade. And we call that edge from the findings the life cycle advantage. And we're going to share that with you a little bit today. So we have to, though, start with the market. It's been brutal for growth stocks and for IPOs. So we've been in a bear market for growth stocks for over a year. And what we have on the chart here for you is the Renaissance IPO ETF. So you can see, these charts are all from last week, Friday's close. But you can see that it's down significantly. I mean, at one point, I think it was down already 60% off its highs and significantly down year to date. So it's been a pretty brutal bear market for growth stocks. And that's why we wanted to really lead with risk management. I know Brian talked a lot about it. We talk about it in our book. It's very important to have the trend in our favor when we're trading IPOs and growth stocks. So the first thing we want to have for sure is a strong bull market. We don't want to fight the trend. And we cover these points on risk management in our book in more detail, but we just wanted to mention a couple of them here. Typically, when we're trading IPOs, they're very volatile names. So it's important not to trade too many of them all at one time. It can make the portfolio very volatile. So typically when I'm trading an IPO, I'm going to reduce the position size to limit the risk. And also in general, never risking more than 1% of capital on any trade. And we're going to talk a little bit about this more today, but it's important to choose the rules ahead of time, the sell rules ahead of time for the particular life cycle trade that we're trading. And of course, always stop limits in place. And MCP stops, we're going to talk more about this. Mental capital preservation is so important in this type of a market. And so there is a way to set those stops and make sure that we're retaining profits and not letting the trade round trip.
Okay, so IPOs are acting normal. Do you agree or disagree? Well, looking at the stats, the column on the far right is our stats from the research from our book. And what we've seen over the last few years after doing the research is that year to year, the numbers really come out to be about the same. So when I say acting normal, it's normal based on the research of all the stocks that we studied from 1982 to 2017 that were still traded at that time where we could pull the data. So this is just 2019 to 2021. So we have 3 years, right? And 2020 was the big IPO year. So when you average those out, how many of the stocks have achieved at least 100% gain? Well, in 4 weeks, about 3.8% gained about 100% in 4 weeks. And our research was 1.3. So really not that much different. And then in 13 weeks, 11% gained 100%, 6% in our research, 26, 52. You see the numbers there. So I guess the other point here I just want to point out is that, we think of IPOs, and I used to do this until we did the study, was like, oh, IPOs all go up. They're all the next Google. I need to make sure I get into the next IPO. Well, really, it's a small percentage that goes up 100% in that first year. So for me, it was very enlightening. And I think, to all of us, like, okay, well, we don't always have to be in such a hurry because really it's a small percentage that's going to go up 100% in 1 year. And actually, I don't think I have this slide in here, but the liquidity is really important. A lot of people will ask me about a certain IPO, and have I been watching this on my radar? And I'll be like, well, no, it's not on my radar because it's not trading enough liquidity. And what I mean by liquidity is, the price times the daily average volume. And if I don't have at least $20 million of that stock trading per day, I don't want to trade it. And the reason why is because this 22% and how much goes up in a year, that number goes up to at least 75% have that potential if they trade more than that $20 million a year. So your odds significantly increase if you just at least set a minimum level for that liquidity. Okay, so patience is a virtue. This is statistics again on the far right from our research was the percent of stocks that have undercut the day one price low. So really what we're saying is that most of them are going to undercut their price one low, and a lot of them already have, especially in this horrible market. But we saw that more than half will do it in 3 weeks, and about 82% in 39 weeks, so almost a year. And then from 2019 to 2021, even the really great ones, they have all come back down and have undercut that price low. And this data was taken, this is 2019 to 2021, so it's not does not include 2022, just to be clear there. Okay.
Yeah, even in bad markets, we always like to monitor which stocks, which IPOs are performing the best. And so this table is just it's looking at the last 3 years of IPOs, since 2019. And it's looking at which IPOs are actually up the most from their first day close, because most people don't get the initial public offering price. And you can see even these that have retained some of their moves are significantly off their highs because of the pressure, obviously, of the market. So we just wanted to include that for you. As Kathy mentioned, it's a majority of IPOs that actually undercut their day one low. I think it's like 55% in our research within 3 weeks. So it's not anything that you have to really jump in very quickly for IPOs.
Okay, so what is the life cycle trade? It's understanding where a stock is in its run from IPO to mature stock. So really it's the life cycle of a stock. I'm sorry.
Oh, that's okay.
Go ahead.
Right. Oh,
No,
yeah.
go ahead.
Oh, so really this was just the introductory slide. Kathy's going to talk about the life cycle phases in more detail. In our research, we found that IPOs go through three main types of phases. It's the initial run, then there's a time where there's due diligence, and then there's a time when there's an actual more mature run usually. And Kathy's going to go through those in detail, but what we found is very important is that the appropriate rules are applied during those phases. And that's what we like to kind of in general, if you're interested in what the life cycle trade is all about, we're going to cover some of those at a very high level.
Okay, so this for me, when we did the research, this was the biggest piece that was the eye-opener for me, is that the distinct phases to look for. Because knowing what phase the IPO is in gives you the edge on how to trade it best, what rules to use, and whether, short-term rules, long-term rules. If you're a swing trader, maybe you want to trade this IPO advanced phase, which I'm going to talk about first. Or if you're like me that likes to hold on for longer, a year and a half or more, then I'm waiting for the institutional advanced phase. So those are the three phases. The first phase is when that first IPO comes out. It maybe builds an IPO base and it has an initial run up. That's the IPO advanced phase. It's a tradable phase, but it's usually very fast moving. The institutional due diligence phase is the phase after the IPO advanced phase or IPO advanced failure, because they don't all go up right after and build a nice little IPO base for us to trade. And that's what we call the watch phase. It can go down for however long, and then it's going to go sideways for 6 months to a year, 3-4 years. But that's the watch phase where you're looking for, tightness or fundamentals to change to really create that first base of some sort that is going to transition it into the institutional advanced phase, which is my favorite phase, because to me, that's the most rewarding. That's where you're going to have potentially a year and a half of 100% or more gains. And you can really get in early as it transitions from those two phases and then hold on for the long run. So again, just knowing where a stock is in that life cycle is just, I think, crucial to successfully trading IPOs. And so we're going to look at some charts. This is a line chart, a weekly line chart of when it starts from the IPO, and you've got the IPO advanced phase right there. And there's the arrow that goes with it. And then you've got that long institutional due diligence phase. This is where the institutions are trying to figure out, okay, is this something I want to hold on to? Because if we all know, mutual funds like to park in their money, get in early, and then hold on to it for a while so they don't have to sell and do a lot of trading as well, kind of like me, I guess. That dotted line is the turbulence zone, and that turbulence zone is marked by the prior high that was created during that IPO advanced phase. And if it didn't have an IPO advanced phase, then it's just whatever that high was from that week one of trading. And then you've got the institutional advanced phase or the accumulation of shares, and then eventually, they don't all go up forever. Even Shopify, that's
Right.
one of my ones that I'm always studying. I don't know what happened to our graphics here, but just wanted to show you one other one. We have different patterns, which I'm going to highlight in a second. This is a pump and dump. We call this a pump and dump, where I was just explaining not all of them go up, they go down, right? And then they create also a due diligence phase. But if you can get, as it comes back up, makes a little base as it transitions, then you can sit in for that long run at the top. Okay, so I'm not going to go over each one of these in detail, but these are the different patterns that we identified. And they're important just because then again, you know how to trade it. You know how much overhead resistance there is, things of that nature, so that you're applying the right rules to give you the best advantage. So just wanted to show you on a line, like a real stock chart, not just a line chart. This is a Microsoft Market Smith chart of Tesla, and that other line chart was of Tesla. So this is just showing it to you in a different way. So in this case, Tesla had about 2-year, 3-year institutional due diligence phase. So, it took a while. Coinbase, pump and dump, still going down even further as we speak. These charts were taken at the end of
last week.
Yeah, last week. Thank you. One hit wonder.
Oh, right. Yeah, this is an older chart. This is GoPro. So you can just think of a one-hit wonder. It has an initial IPO move and then just undercuts and moves lower from there, undercuts that entire advance. And it's just really an upside down V. You never know if it's going to come out of it again, but GoPro so far is a great example of the one-hit wonder. Yeah.
Oh, bizarre.
Oh, and then we have the rocket ship pattern. That's one of my favorites, definitely. This is an earlier chart of, can anyone
Upstart.
recognize it? Oh, okay. You gave it away.
I gave it. It was on there.
Oh, okay, Upstart. And typical of a rocket ship, it doesn't give you any time to get in usually. It just really starts taking off immediately. Obviously, Upstart had a massive move. Not all of them have a move as strong as Upstart, but the move is difficult to get into and is pretty breathtaking in a rocket ship.
And like we were talking about the statistics, I mean, I think it's already undercut its day one low or pretty close if it hasn't already. So again, just another example. These are, those initial advances are really great. They may not even have an institution. I mean, it's going to start one, I guess, eventually, or it could end up being a one-hit wonder. It might transform. I don't know. Anyway. All right. Stair stepper, Zim.
Oh, yes. So this is a great example of a stair stepper. These are a little bit more rare. I think Google was one of the famous examples. But this really just starts its initial advance right away. It's institutional advance phase. And it goes through phases, forms different consolidations, and gives traders an opportunity to get in. So we wanted to include that as an example for you, a more recent one. And we have a ton of these examples in the book, a whole chart of some of the famous examples as well. Okay, so next we're going to talk a little bit about trading the different phases, and I'll cover the IPO advance phase, and then Kathy's going to talk a little bit about how she trades the institutional advance phase. So if I'm trading an IPO when it's in its initial move, I'm going to typically use daily charts to decide whether to get into that IPO. And I'm not going to buy on day one. Our research found that really you don't need to be in a hurry. Wait for some type of a consolidation, a little base. It's going to be shorter usually in duration. And I'm going to start a smaller position typically because of the volatility. Otherwise, the risk is high then, and it's easy to get shaken out of these names. And one of the things that's a little different when I'm trading this phase is I'm not going to typically pyramid my position. I'm going to really try to keep my cost basis low because the intraday volatility could easily knock me out with tight stops. And typically what we found in our research for this phase, fast rules, faster sell and take profit rules are important to be used here. And you could see that in the examples where the entire advance can get easily taken out. So I'm going to use faster rules and typically sell at least a portion of the position into strength when I'm trading this phase. And we have a couple examples for you just to take a quick look at. So this example is Airbnb, and you can see this is the initial move, and it's very quick, right? We've got a weekly and a daily chart for you. The advance was only 10 weeks long, so again, that just reinforces what we found in our research, that it's really important to use fast rules when trading this phase. So a trader could have gotten in at some of these smaller consolidations if they got in early enough, but you can tell on the daily, very easy to get stopped out of these. And had someone tried to hold onto it, it would undercut this entire advance. And the other example we have is snowflake, snow. And again, the daily and the weekly chart, you can see it only lasted for weeks again, the move, and that entire move was undercut as well. So the fast rules are really critical in this phase.
Okay, the institutional advance phase. So this is where it works out really well because, Eve and I are really good friends, and she likes to trade the IPO advance phase, fast movers, always looking for also high tight flags if you're familiar with those, and all those skyscraping stuff there. But I'm more like low key. I'm the, just get me one in, and maybe even a stair stepper really is what would be good for me. But institutional advance phase. So in this case, weekly charts are really important for proper phase identification. And I really want to stress the weekly charts because I know a lot of people love daily charts and that's what they trade off of. And maybe that's because they're all swing traders and I'm not a swing trader. But I think I really want to reinforce that because sometimes people will ask me, oh, I think it's starting the institutional advance phase. And I'm like, well, that's a daily chart. So you might think it's in the institutional advance phase looking at it from a daily chart perspective, but really it's not. And so then therefore you're still in the IPO advance phase and you need faster rules and need to manage because likely it's going to be more volatility. And so, it requires patience, right? IBDP, we call for short, it may last 6 months, 2 years or more. And then I already mentioned, I want to look for that first base or consolidation off the bottom, and we'll look at some examples. There will be some volatility, of course. I mean, just trading stocks in general, they are volatile, but especially when it comes back to that turbulence zone. Again, we'll look at some examples. And so medium term to longer term rules along with the mental capital preservation stop, which we're going to talk about, can be really helpful for this phase. Okay, so we decided to use the same stocks in both examples so you could show how, okay, it had a good IPO advance phase, I've traded it, then you're done, you wait out the institutional due diligence phase, and then you come back to it for the institutional advance phase. But unfortunately, I think these stocks have gone down. Well, I know for a fact, Airbnb is already, it was the only one or one of the only ones that was still holding its low from that second week of its IPO, and it has already undercut it. And this was just from last week, so yeah, it's already looks worse than this. But this was one, we were watching a lot, thinking that this was going to be the turnaround play and opening back of the world from COVID and so on and so forth. But anyway, you see the IPO advance phase, you see the due diligence phase. I've marked, I don't know if this has a pointer, but I'd have to point up here, so I'm not going to do that. Anyway, and the turbulence zone. So we never even made it to the turbulence zone. It tried to there a little bit in the middle of the December timeframe, but it's just gone down from there. So at this point, yeah, we're just waiting for some kind of rise off the bottom for a new base when this market turns around. But by that time, we're probably going to be looking at new IPOs, to be honest. So we'll see. Okay, and then Snowflake, again, we had the IPO advance phase, and it came there, look, it came right up to that turbulence zone, and I traded this. I traded it as it was coming to that 40-week line. No, yeah, there's a pointer. Oh, okay. So right in here, I was trying to get that first little consolidation base from the bottom within the institutional due diligence phase. That's where I like to get in early. And then my second thing that I like to do is then when it comes in the turbulence zone, it's going to get choppy again. So usually there'll be a base of some sort that I can try and get an entry in there. But here it didn't work. So I had to get out of it. And I think it's gone even lower than that. But if it had, then I would have been in early, or I said here. And if it kept going, then I could just hold on to it until, year and a half, hopefully, right? That's my goal, and then get out of it. Okay, so now we're going to talk about the mental capital preservation holding method. I use this a lot, and especially when I'm in a stock early in that institutional advance phase. And basically what it is, it's just determining a minimum percentage of profits to retain while holding a leading stock for a bigger move. So if any of you have read Jesse Livermore's book, he was really big on mental capital preservation, and he has that famous quote, which is my favorite quote, about you really make your money from the sitting. And that's what I like to do. It's just I like to get in early, and then I just like to sit so I can do other things, work out, have lunch with my friends, and not be stuck to the computer screen all day. It really works best after achieving gains of 100% or more. So this isn't something you would want to implement. I don't know why the print's kind of off there, but anyway. It works best after 100% gains. So when you're getting in early, you're not, if you only have like a 20% gain, you can give it like about 8% off from the top just to retain 10% of your profit. So it doesn't really make sense to use it in that. You can use other sell rules for that. So here we show on the 100%, it says with the pullback. Now this is using MCP 45, so that's retention of 45% of your profits and 35%. And the reason why we use those is because we were really looking for the long haul, like if you could really hold a stock through multiple corrections, a real true market leader, super growth stock. So what it's saying here is you could hold from the top 27 to 32%, depending on which one you want to use. But you could use 60%, which is what I like to use. I just like to use 50 to 60% retention of profits. And the reason being is that keeps my mental capital preservation sound. When a pullback comes, I'm like, well, that's fine. As long as I'm always retaining 50% of my gains, then I usually don't have a problem with that. And for me, that usually works out about the 40-week line. Coincidentally, we didn't really study that. So like, for example, Twilio, CrowdStrike, some of the stocks I had those early. I bought them during that transition. And then I was able to sell it at a retention of 50% gains right around where that 40-week line was coming into play. Did you want to add anything?
Sure. This is such a key concept, I think, that we outlined in our book. And it's just so important for a bear market, mental capital preservation. And we called it that because it's really important if you have a profit in a stock to retain some of that profit. And these types of stops have saved me in bear markets. And the reason for that is you can have a stock advancing and then you can fall in love with that stock and it can do no wrong. But if you know where you have a line in the sand drawn, where if it starts acting poorly, you are willing to give back a certain amount of profit off the top, but you're not willing to give back that entire run. We studied this and we have this outlined in more detail in our book, but it's pretty fascinating. Some of the big leaders will hold like an MCP of 35. So if you look back from 2013, when Tesla first began its big move, and if a trader got into the stock at that point, the stock, I believe, has still held that MCP 35 up until today. We also studied other rules, and those are all outlined in our book in terms of what's the best way to try to hang on to a leader. And that's something that Kathy typically tries to do as she's going into that institutional advance phase. And mental capital preservation is one way of doing that. But there's other rules that we also tested, like the 40-week rule. If a stock doesn't actually hold that 40-week line and closes below it, that could be another point for a longer term trader that's trying to hold on to a big winning name. Okay, so this is the life cycle advantage. This is what we feel is our edge after we conducted the research, again, looking at decades of IPOs and growth stocks. We talked a little bit about some of these, but I want to go through kind of how we remember them very easily. So if you look at it, it's lives, right? It's the life of a stock. And we can summarize it. Kathy's gone through the life cycle phases. So really, first of all, the big revelation to us was that we found these phases that the stocks go through. And it's really helpful for trading because we know which rules to apply based on which phase we're in. And we kind of avoid that choppy phase of the institutional due diligence. We're not very eager to jump in right on day one. We know during that initial advance, we're going to probably lose most of that and undercut, so we're using faster rules. So the phases is first, the life cycle phases. And then we have the IPO life cycle patterns, which we showed you. Now, we left one out. Did anyone catch which one we left out on the charts?
Go ahead.
Oh, yeah, we didn't talk about that. That is important because that can put some pressure on. But one of the patterns we didn't talk about is disappointments. We didn't show the chart in detail. Why? Because all you need to see is a chart that's going straight down, right? And we want to say that most IPOs kind of fall into that category. There's a lot, we don't even look at the illiquid names. So we're focusing, like Kathy mentioned, volume, average daily volume has to be greater than 20 million per day. But if you look at some of the smaller names, the illiquid names, The disappointments of the world are just, the stock never goes anywhere.
10% of stocks will reach their high and never go higher. So it's,
Yeah,
10%
yeah.
will reach their high and never go higher. So it's just kind of crazy how, I mean, I guess that seems like a small percentage, but then if you also put that in with the 20% will make 100%, and then that's in a year. I mean, it's just, the odds really are against you. You got to be good at faster with your rules and really pick really good stocks.
Yeah. So the I is for IPO life cycle patterns, which we pay attention to. We try to determine which pattern the particular IPO is following. And then we talked about volume. So the V is for volume, very important. 20 million, that's kind of a bare minimum. I'm going to look for much more. Typically I don't want to be more than, 2 to 5% as a maximum of daily average dollar volume. So it's going to be much higher than that. But in the book, we use that 20 million because we want to have at least some liquidity in there. And then we didn't talk about this a lot. This is more the fundamental side. So while we can choose any IPO, we can choose what stock we want to trade, we want to look for the exceptional companies, right? So we want to look for those that are disruptors, that are innovative, that have drivers for future growth, because that's what's going to make that price go up over time. So we're looking for exceptional companies because we can choose. And then finally, we talked, the S is for sell rules. Very important to use the appropriate sell rules based on what phase you're in, which life cycle phase. So we call that the life cycle advantage. It's the lives of stock. Wow, that looks small, at least on our screen. So super growth stock lifetime gains. Again, we mentioned disappointments. There's a lot of disappointments out there for IPOs. So we wanted to, when we did the research, we were like, is it really worth, looking for these IPOs and trading the IPOs? And we found yes, because there are a number of stocks that do achieve phenomenal runs, right? In that elite category where you see greater than 2,000% runs over a lifetime, that's going to be the elite group. So you're going to have, the Teslas and the Amazons and of the world. But there are 10% of stocks we found do achieve 10-bagger status. So, that's worth going after. That's what we thought. And then again, you see that a little bit more than half achieve that 100%. So again, 10 baggers, 10% worth going after. And if you can handle 1 or 2 stocks and really handle them well through that institutional advance phase, it can really turn into a life-changing life cycle trade. We saved the best for last.
All right. So now we're going to put you to the test. See if you remembered anything that we said.
And we didn't tell everyone before, but we do have prizes. So we have a book for those of you that don't have a copy of our book. We brought some desk reference material for some of the charts that are in the book. We have a life cycle t-shirt that we have as well. So kind of fun prizes that we'll give out to those that can name these phases, patterns, and stocks. So the first one.
So what life cycle phase is this?
Okay, and this is, did we say what kind of chart this is? Daily? Daily.
Okay, I saw Manisha's hand go up first, I think, already. I was trying to, so. I'm sorry, what'd you say? Institutional advance phase? Which one are you think it's the institutional due diligence phase? Okay, and do you know what stock it is? Well, actually, how do you want to? It's not the institutional due diligence phase.
Any other guesses?
Okay, I think he was next. I'm sorry, I don't remember your name. Mark. IPO advanced phase. Is that correct?
That is correct.
Okay, do you know what stock it is? No. Okay, are we?
Does anyone have an idea?
No.
No, but that's a close answer because Upstart had that huge, fast move.
The guy in the pink. GLP? GLBE, no.
No, these are tricky because we gave them to our team
Okay.
members and blocked them out.
Richard?
And people couldn't guess them all.
No, it's not Zim either.
No? Okay, we'll give it away. We'll give it away. But we do have a winner on the phase.
Yes.
So you get a prize. Come see us later.
Okay, so the stock is?
The stock is.
Oh, that's right.
I hope it shows up.
No, it doesn't.
It's Twilio.
It's Twilio.
This is Twilio in 2016. It formed a high tide flag, like a short high tide flag type of pattern, moved out. Now we show this 6 months later, so you can see what happened. So the initial chart that we showed, that's the IPO advanced phase. But what happened here? It gave up that move before it had to go through a due diligence, and then it finally had another institutional advance phase. So again, if a trader tried to use long-term hold rules, likely going to give back all those gains. But this was a phenomenal short IPO advance phase. So good. Okay, so we have the next one, right?
Okay, the
Mystery
next
stock.
one. What life cycle pattern is this? And this is also a daily chart, right?
Yes.
This is a daily chart. What life cycle pattern is this?
Yeah.
Okay, Manisha? What life cycle pattern is it? It did undercut day one, but what pattern is it? Is it a late bloomer, a pump and dump, a stair stepper, a one-hit wonder, disappointment? Anybody?
So it had that little, it tried to move out a little bit, and then it kind of went, it's going through its...
Pump and dump? No. No, not a one-hit wonder.
These are tricky, especially when
In
we're
the
showing
back?
the daily.
No. Well, it is in the institutional due diligence phase. That is correct. But we want to know if you know what life cycle pattern it is. No, not one-hit wonder.
There's some famous ones. I'll give you a clue. So one of the famous ones that was under this pattern was Tesla, and we showed it earlier.
Late bloomer. There you go.
That's the one I got it.
The one with this hand up.
Okay,
All right.
see
so
us for a prize afterwards.
okay. Does anybody know what stock it is?
Yes.
Wow. Okay. So we got a Peloton and you're
Yeah.
keeping track of all this.
Oh. We're going to do the honor system. You guys see us afterwards.
All right. We've got to
and
make
we'll
sure we
give
don't
you-
run out of prizes though.
Oh, I think we have 6. So.
Okay. So we got,
Okay, so this was a late bloomer pattern. This was Peloton in April of 2020. So it had an amazing move. This is 6 months later for Peloton.
Yeah. So
Yeah.
here was the base, right? It had that initial IPO advance phase that we were pointing out. And then here was the due diligence phase. Now, this was a short due diligence phase, right? And then, we had 2020 and everything was just going up. And, this is the 40-week line. Usually I like to wait for the 40-week line for that transition from the institutional due diligence phase to the institutional advance phase. But this was so quick. I mean, it just took off, and then you literally could have ridden it, on that 10-week line. So
And I think it's come all the way.
it's all the way
back.
back to under 17. I think.
Unbelievable
So,
what a
yeah.
bear market will do.
Okay.
Another mystery stock. This is a tricky one.
Okay. Is
Anyone recognize that?
this a weekly?
This is a daily.
This is a daily chart,
chart.
and we're wondering about the phase. What phase is this? Is that
Yes.
correct? Yes, very good.
See us for a prize afterwards.
And what stock is this? Anybody?
I'll give you a clue. The next day was a massive gap up. Sorry?
No.
No.
Not Rob. No, not Upstart.
This is tricky. It's not doing anything now, and after that gap, it.
No, not Dutch Brothers. What's that? No. All right, one more guess, and then we'll. No.
Okay.
Is Spencer here? He might know.
Oh, yeah.
No, he's not here.
Okay.
Okay, go ahead. What is it?
All right. Let's show it.
Oh, yeah, we didn't put the name.
Oh, we didn't put well, they were up way on top, but they got deleted. This was Rocket.
Yeah, Rocket. So we said, I said maybe Spencer would know because I think they're in their office building or something.
Yeah. So this is the weekly 6 months later, but if we showed the daily right before, it was that it had a 70% gap up, and it kind of coincided with a top. So it tried to move out of there, but just couldn't do it. That 1 day move was unsustainable during that phase. So currently it's going sideways to down. Okay.
Okay. So the question is, raise your hand. Try to see. What pattern is this?
Now we tried to cut out the dates, but there's a hint there.
Pump and dump? That is correct.
Wow.
Good
Great
job,
job.
good
Great
job.
job.
And oh yeah, was this a daily or a weekly chart?
This was, I think it's weekly.
Okay,
Yeah,
and
I think it's
what
weekly.
stock is this?
This is very tricky.
Very tricky. It could be any stock from any time frame.
Yeah. It's a famous one.
But it's famous.
Anyone on this? Okay, so think of it. It's the IPO, and then it does this 3 waves down.
Yeah, just yell it out. No, not Amazon. No, not GoPro.
So the hint is, if you can read the date down there, that might give you a hint.
Home Depot, no, but I'm good. I'm glad you're going back in time. Apple, who said Apple? Oh, okay, there you go. I think you got won another prize. Okay. So pump and dump, Apple, and then this is what happened 6 months after. So, and this, here's that 40-week line, still went down, came off the bottom, maybe even a tight consolidation if you knew the story. Past the turbulence zone. So,
yeah.
Was that the last one?
We have one last
one more. One more.
One last prize.
Okay, this is a weekly chart. What phase is this? Weekly chart.
Yes.
IPO advanced phase. Okay, well, we get the big winner here.
Yep.
All right, IPO advanced phase. And then what stock is this? Because it still doesn't show.
Nope, we're hiding it. We didn't want anyone to cheat and look ahead.
What stock is this? Google?
Close, but no, it is a famous one.
Chipotle?
No.
What's that?
Yes.
Tesla.
That's
Wow,
right.
there you go. Good job. Good job.
This is Tesla. So it had this short. This is showing the chart 6 months later from the previous one. And you can see it had that initial move. And then we don't show the chart all the way out, but for a couple years, it just went sideways through that institutional due diligence phase. So this is the first chart was Tesla in 2010, then 6 months later. So it went through that institutional due diligence phase and then finally started its big move in 2013. So give yourselves a hand. That was a great job. These are really tricky. Good job.
Okay, I think we might have just a few minutes for questions if you just want to ask any random questions. Oh, that's a great question. So the question is, the stocks that break through the turbulence zone the quickest, are they more? Yeah, right. Well, I really think it's, let's see, where was it? Was it this one?
Yeah.
I mean, I really think that was a function of the market. It was 2020. We had the pandemic bear, then the pandemic bull, like literally, boom, boom. I don't know. What are your thoughts on that?
I would agree. The market's always first in terms of whether it's going to put pressure or support some of the riskier IPOs or growth stocks. And this was one of those stay-at-home plays. It did have a little turbulence still when it moved through there, but It did move with power. I typically like to see that power where it's like following through through the turbulence zone. Otherwise, it might get stuck, and investor or trader could get stuck in that chop. It may form another base and then try to come out of it. But it is a sign of strength, I would say. Yeah.
Okay, another question? Okay, so once you're in a position, how do you manage it with stops and such along the way? Or taking partials. Well, Eve and I are very different. I mentioned earlier, I like the institutional advance phase. And I originally started trading. I still trade under William O'Neill's How to Make Money in Stocks Can Slim system. So, I get in, I'm using an 8 to 10% stop loss. At the end of the day, once I get 20%, if I can get, 40 or more, I'm going to make sure I always retain at least 20 to 30%. But then once I get into that 100%, then I'm using mental capital preservation stop. And then I'm looking at retaining 50% of my gains and also seeing how it responds as it goes up with the 40-week line. Because just like with the 10-week line, a stock will come back, touch it, and keep going. And I'll see that in the longer term time frame, a really strong stock, it'll do the same thing. It'll touch the 40-week line, and then it'll also keep going. So that's when I'm using those longer term rules of the MCP holding method. But Eve, I'll let her answer.
If I'm trading the IPO advance phase, I'm going to be taking some of the profits into strength because I just know how quickly those profits could go away very quickly. So, and then I'm using shorter term moving averages. So typically the 21-day EMA when I'm trading the IPO advance phase. If I'm trading the institutional advance phase, once it's kind of trying to come out of the institutional due diligence phase, it's going to be a different set of rules that I'm using. So if it's a high conviction name that's like disruptive, growth drivers, and starts making a really good move, I may use a mental capital preservation for at least a portion, a core position of MCP 35, but I would need to hedge that position, if it's going through some turbulence or rebasing. And then I do look very closely at the 10-week moving average, and then the 40-week if it's for a long-term hold. But that would only be for a portion of the position. I'm going to be taking some of it off into strength, like if it goes into a super parabolic move. But I always have this point in mind of how much I want to retain if it's a high conviction name. And I found that the MCP rule really helps with that. So, yeah. Good question.
So the question is, what criteria and routine do we use for screening for IPOs? So $20 million a day is my minimum. And then I look back about 2-3 years, and I just start with just what are the ones $20 million a day. And it's actually really not a whole lot. And once you screen for it often, you're familiar with the names, so you can actually go through it quicker. So that's really my bare minimum. I do look at the fundamentals, but I don't screen on that because I wanted to be aware of all of them. Eve?
So I'm screening for power strength, so which IPOs are acting the best from their first day close. And then I'm also looking at which ones are liquid. Now, for me, I can only trade, it needs to be like 100 million daily average or higher. So I'm usually going to put that screen in there as well. There's a few screens that we listed in the book. I run all of those. So there's something called Rare Jewel. Kathy and I maintain a list of that. So those are rare jewels. We talk about it more in the book, but it's names that have very quick 100% moves. And it doesn't mean like, I'm going to go in and buy it there, but I'm going to keep an eye on it because maybe later it will come through an institutional due diligence phase and have a huge move. And I'm thinking, if I'm correct on this, I believe way back when Twilio was probably in that category, Roku. So it just made me keep an eye on it. So definitely I think there's 3 screens in our book. I run all of those. And then I'm looking the last 3 years, which IPOs are acting strong, percentage move wise.
And the rare jewel screen that she talked about, so it's 100% in 90 days, then we'll put it on our list. And the reason why is because, again, when we ran the research, we saw that the stocks that did that were twice as likely to gain 500% or more. So that's why we have a list for those that we want to keep an eye on. Shockwave was another one. InMode was one. So just like a handful. And they came back and they were big winners. But I mean, not all of them will do that. But it does seem that it puts them in a different tier.
And I always want to see strong revenue growth. So I may put that in there, 40, 50% this quarter versus the same quarter last year. So I'm looking for those exceptional names. And, I may give them a break when in terms of earnings, they might not be there yet, but the revenue growth, it has to be there. So I think they're cutting us off.
Yeah, I don't see the hook, but we'll be at the cocktail hour and we'll be here the rest of the day. Thank you for listening. Thank you for your questions and your participation.
Great job, guys. See us for your prizes.
Oh yeah, prizes.